You're listening to the Valley Current.
Hey, Will, how you doing?
Good.
You look great, man. You're looking so youthful. You gotta be in your 30s by now, right?
Counting backwards. Thank you.
So tell me, just generally, what you're doing these days, because I've always known you as a brilliant student from our time at Columbia Business School together. But then I think you went into the hedge fund business, but remind me, because the last time we talked over lunch, which was quite a while ago, and you look the same, so congratulations, you're handling what I call the health quotient really well. Tell me what you're up to.
Well, I work advising people in investments, and I make investments the same way I was doing it when we met, and actually my whole life, which is more in a value orientation, but with the ability to go into tech, which is sometimes very expensive and you need to have some know-how. So, I was operator there for years, from startups to mid-sized companies.
Right.
And I did a recent turnaround in the past 10 years just to get back into how should a company operate.
Okay.
And I go beyond that. I think when we were talking, it was the banks, it was the housing crisis of 08, 09.
Right.
Followed by insurance, fund and insurance companies, followed by some old tech fund, and then off to the next pandemic, always natural resources, et cetera. And
I want to say that I thought you were not with your own firm, but you were with some bigger firm back then, and now you're on your own, right?
Yeah. And originally I had been offered a job to go and manage a company's fitness watches when those were like the thing, and it was early years to go throw your steak out. And so an older guy who was in his, he's middle age in his 70s, asked me, what are you doing with your money? And I said, well, this is what I do. This is how I invest. And he actually knew the answer before I was in the room much with him. And we spent probably a couple weeks or more, maybe 2 months talking a lot. And I had no idea I was being interviewed.
Okay.
He had gone through a bunch of guys, and he was looking for somebody who had a disposition, trading in numbers, could ask hard questions as an operator, and could learn. Yeah.
So who was that, and what's the name of your firm now?
Well, that's the last firm I was with, and the man's name was Ed Sickle. Okay. He's now in his 80s. He's doing great. Okay. Smart as a tack. Started as a sales side research guy here in the city, and following tech from way back when, from hardware on. And now today I'm doing consulting mostly for family offices to other high net worth individuals, to companies. And this past week, it's been quite a few companies asking simple questions, and people in difficult situations involving investments.
Right. And it's so apropos that you've come on a Sunday night or afternoon, because we're talking about Silicon Valley Bank, and it's been in the news all week, and we've been watching it. Maybe you've been watching it far longer than I've been watching it. I banked there or the firm has banked there for many, many decades. And we've always known it as a sort of VC-based firm. VCs love it. They get lines of credit. I called it a dirty secret, but I said it's not that dirty. It's not that secret. But you've probably been studying them for a while, right?
I would say the folks in value investing have marked them, going back a couple years and more, since their existence, as a potential place where concentration could be an issue.
Well, they're geographically concentrated for sure, and then they're concentrated in that segment, right? The early stage segment.
They bought a little bank in Boston.
Boston Private. Yeah, we used to bank with them, right? Yeah.
And they have offices from here to Hong Kong.
Okay. So they've got geographic diversity, you think, to some degree.
Yeah, and one of the strong assets they do have are their people and relationships, and their understanding of the business, like you say. It's not an easy business to come from. When I came in doing full-time value investing, I actually came more with a head on the shoulders of doing venture and looking at new venture, which is very fundamental. Is there a market? Do I have a competitive niche? Not sure what I'm going to create yet. Somewhere along the line of 8 different business models, I hopefully will find the right one sometimes for some. And so, there's a good mesh in that. So
your family is actually in banking. Like your family goes back a ways in banking, right? Tell us that story, because you go back generations. You guys came over on the Mayflower, didn't you?
Well, that's a different part of the family.
Yeah.
I think we've all come over here for a lot of different reasons, and we're thankful we're here because we can be and do what we want in a free country.
Right.
And today's actions may question that for some, and for others it may be that kind of freedom that we need. So regarding the banking in the family, we came out west in a time when you needed to create your own bank at times with friends. Once you built up enough reputation in business, you typically got together with other partners and formed a bank. And it would be the local bank where you'd put your money, they would put money, and new folks would get loans, et cetera. And our family was the main group in the bank. And a couple Christmases back, I was given the deposit book of my great-great-grandfather, and it goes to 0. And my mom explains, that's the day we paid out everything.
Wow.
And you can go to 0. And this is one case where you gain a lot.
The reputation capital is huge, right? Yeah. That's a huge point. And a lot of people don't realize that, and don't realize that maybe what the VC should have done is said, look, we're going to gang up together and create a syndicate, and we're going to find the shortfall of whatever number of billions together. And they hopefully would have stood right beside Gary Becker and said, the CEO, on that fateful Monday when he took questions, and said, look, don't worry, this bank is not going to fail. And they didn't do that. And that's a real character defect, in my opinion, of the Silicon Valley that I've known for going on soon 5 decades, because it wasn't that way even 3 decades ago, and certainly wasn't that way 4 or 5 decades ago, because there was more of a mentorship, and we're going to help people out, and we're trying to do the right thing for the Valley and its ethos. That seems to be gone, and that's really sad. It's almost like the beginning of the fall of the Roman Empire, or the fall of the Silicon Valley Empire, if you want to put it in today's terms. And I'm a bit sad about that fact, and the fact that Gary Becker was there alone.
Yeah.
And your great grandfather, how many grandfathers back are we? Right. I mean, people don't remember back in those days, there was a little book called the Pass Book, or Pass Book. I had one. I remember it was like so amazing that you saw your balance on a book, and then they would update it when you put a new deposit in, and they would show you how much interest you earned on that savings account. So people don't remember that, because now it's totally electronic, and they want to get rid of all paper and so on and so forth. So you have that same kind of DNA in how you look at things. And I imagine you're looking at Silicon Valley Bank in a similar way that I am, to some degree, right?
Yeah. I think, it's good that folks like you are talking about how to do it right, and think the long game. The long game needs to be that where you do consider there's obvious value. There's those relationships, those depositors, and you can't get that back that quick. Look at the size of the goodwill on their balance sheet. It took them a long time to get there. And you can say that maybe first some of their acquisitions may have been overpriced, but that's me as a value investor.
Right.
that might be fair in the venture world. So it had its time, it had its moment. They missed it. It sounds like we're getting lucky potentially here in the Valley with some backstop in the short term, but we're violating dynamic consistency in the sense that we're getting into the business of saving everything. And in this case, it can be said that the Fed caused this. So why shouldn't the Fed fix it? And that's, I think, going to be a fair discussion for us to continue. The Fed pumped the money in, that pumped them up. And then the Fed took it away, raising interest rates.
By 450 basis points in less than a year, right? If you look at what things
and then look at the earlier attempt before the pandemic, and look at the reaction then with companies and how they got shaken really quick. We think we can put things and run things in a textbook, and you just don't have it. That's why behavioral finance is important. Thinking that I need a margin of safety because there's no such thing as an efficient market is a good idea. MMT, which is based on that basic idea, it doesn't work. So we will hopefully maybe learn from this one, but we didn't from the housing.
Well, we didn't from Washington Mutual either, right? That was the biggest one to date in recent times, right? $300 million.
So, and that's Great American West, right? Or Golden West. What was the preceding bank with the characters that own that? And we were originally actually with Wachovia Securities. So as an employee, prior to that takeover, I watched my coworkers lose their 401k in the ESOP portion of the 401k.
Ouch.
Which is a dangerous, you're playing a double game.
Right.
You have your job and then you have stock options, especially like those in the 401k. And so, the learning after that, of course, is as soon as Wells bought us and on the low, I was in the 401k just doing 100% Wells ESOP, but then shaving it off when I had the chance later.
Right.
So it's so WAMU's taken over by Wells, and it's great to see a big bank come in and fix it. But then Wells goes along for a little while and realizes that there's this wonderful product called Pick a Pay. Right. Pick a Pay was almost, when am I going to pay you, the bank? Am I paying interest? Am I going to pay it now? And so we had a couple of clients who just said, go ahead, you might need this Pick a Play because you may need to delay a little bit. Mm-hmm. Wells was a smart player then, like now. They probably did certain things right, certain things they did horribly. And they're paying for that in reputational terms.
Right.
But the one thing that the smart guys, especially on the commercial side, did was extend and pretend that your client's going to pay you eventually and help them along on the finance side. That didn't happen in every single case. I can't speak for the whole there, but that's the way to act as a partner, an investor, if you truly believe who you invest in. So when the VCs had that chance this week to go, a lot of them did actually. A lot of folks called their financial heads and their founders, and they said, we got your back. We'll raise what we can. We'll step in to some degree. And I find that those are usually the older established. Some of the younger sound like they've done it too. It would be good to hear those stories.
Right. There's going to be a lot of stories because I do think they didn't do it in a public way. I mean, this is my criticism of what I see. They needed to maybe, SVB just didn't request it or didn't honcho it. It takes a while to get people together, obviously, particularly now. But conceptually, they could have gotten a bunch of people together and made a statement that, hey, we're going to make sure, or you try to go to someone that can peel off a few billion pretty quickly, like a Warren Buffett, And, Elon Musk, although his hands are pretty full, but there's a number of billionaires could easily peel off 10 billion pretty quickly. Bill Gates comes to mind as well. And, I think the bank would have presumably given a pretty solid position of preferred stock to those players. It probably would have been pretty protected. It's kind of surprising it didn't happen. And I sort of wonder whether Goldman is going to take some lumps here, because they were running a book to try to put together a deal that apparently was half-baked. They didn't have the investors lined up. I mean, it's surprising to me that in a situation like this, a Goldman Sachs can't be more nimble about plan A, plan B, plan C. So, I mean, they're a bank too. They're actually a slightly bigger bank. I don't know what the conflict of interest is there, but I'm sure class action lawyers are going to be asking those questions, right? That's the other fallout that's going to play out here for sure.
You've hit on one major thing that maybe we can help your listeners understand. And that is a theme that's close to my heart and where I started in value investing with my the firm I was with for so long. In 2007, I learned what a mortgage is. Prior to that, I had no understanding. But I had this 75-year-old man next to me who'd been through multiple cycles. So it's good to have a mentor around. And through that learning, and talking to lots of folks throughout the nation, it becomes pretty evident that banks in particular, as something to invest in, should be considered as faith-based companies. Now, you can say that other companies or other industries have the same thing, such as, say, proven reserves of an oil company. Or we really did send the product out on those trucks, and it was booked on time with real revenue that will come in later. Things like that. There is a little trust me everywhere, but banks in particular are faith-based companies because of the deposits.
Right.
And the key word is on demand. Mm-hmm. Those can flush out so quick.
Right.
And so behind that, you have a small piece of book value.
Right.
And that, and this is, it's tough to kind of manage this world in a sense when low interest rates, and you have characters who still want to reach for yield.
Right.
But going into some of these so-called mortgage backs that I'm not totally sure what they had yet. Mm-hmm. It sounds somewhat plain vanilla, but there could be a situation where they had some strange stuff in the mix, or there could be a macro event that may be bigger than just banks having a problem.
Right.
Liquidity, say, with certain asset classes can be a problem at this point. And I could go on that in a minute, but just rolling through the bank thing is, I was conditioned with the 1930s, and it was easy to understand a margin of safety. Mm-hmm. I went through the S&L crisis, and when I got my first job as the analyst full-time, my dad said, "Hey, I want to depose this guy on the stand after S&L, savings and loan crisis." And it was South West Bank that bought property in California. And the analyst had gone there on a rainy day and looked out the window of the car because he didn't want to get out of the car and get his shoes dirty. And that's literally what he had written somebody else in the note that came up. And that was a very embarrassing thing.
Right.
Not to go do the due diligence.
Right.
It turned out that nothing had been built. There was maybe some wood frame there. Right. In the development.
Yeah.
And so you gotta really be in the field. It's people are talking about depositors being investors. To an extent, they are beyond the limits of insurance. But to an extent, they don't have the skills at the time to be doing credit risk, liquidity risk.
No, I mean, they're being told by the VCs that just put money in that Silicon Valley Bank is great because Silicon Valley Bank is going to give a line of credit, which might extend the runway, and we've got good relations with them. And it is a pretty well-run bank in terms of automation, those workflows that people have embedded in their systems for how they do cash management. You know, you could think of them as scripts that are running in the background that move money around. I think all of that has a lot of value beyond the people, beyond the brand, beyond the network. Those relationships are pretty important. But I kind of wonder whether all of that value is effectively lost if we don't see a bigger bank or even the same size bank come in and try to scoop it up in some fashion to so not lose the value that's there, because there's a lot of, in the sense of the destruction, there's a lot of value that's going to be destroyed pretty rapidly beyond the shareholder value. I mean, the real asset value. If you go
back, yeah, you got to go back to the people.
Right.
And over a year ago, one of the red flags for the value investing group, especially folks that were watching SVB, was their venture debt team left. You know, this is written in some of our favorite places to go read stuff.
Right.
And so that's now at a very large bank, one of the biggest, that's involved in taking the business. And they're quite capable of, they held the relationships before. What's to stop them again?
So
these folks are old banker, you know, these folks that are bankers over at Silicon Valley, they just need to walk across the street.
Right.
The handcuffs are gone when the bank gets closed.
Maybe that's the canary in the coal mine, which is the venture debt team leaves, and that's a lot of business that effectively is walked out the door over to a larger, bigger bank. Is that what happened? The team left and joined the bigger bank? I didn't know that.
I don't, to the extent of how much business left with them, I can't gauge it. It just was a signal of the spread of the thinking.
Right.
Of Silicon Valley Bank. Right. Which venture debt is by far something you've got to get really, really right.
Right.
That's proving, that's going after unproven reserves in oil, or it's full exploration sometimes for some.
Well, it's going back to the venture capitalists saying, we're going to back this startup, not to worry, we've got dry powder. Your venture debt is going to be, but then, you know, a couple of years ago or 18 months ago, there was that big memo that got issued by, I forget which venture firm, but one of them saying, there's going to be a recession in America, freeze everything for 18 to 24 months, extend your runway to the maximum possible. And that was, maybe that was the real canary in the coal mine, which is the venture capitalists were saying we have no dry powder and there won't be dry powder. And we're holding back until we see what really plays out in the American economy. Because the free money system that Powell introduced, or that was introduced before probably even arrived, that's going to go away. And it's going to change radically on what goes forward in the American economy. I mean,
well, once you introduce that kind of money, or you introduce a situation where there's potentials for bubbles to be created, then caveat emptor. You may need to change, and you won't have time to change when those signals come through. The smart people are out of the room.
Right.
It's interesting to see that even Warren Buffett was selling down his banks the last couple of quarters.
Right.
And so you have to decide who you are going to be as an investor. So in the banks, if you are, and this is going back to the housing crisis, you want to be if you want to make the most money. But this is the most dangerous game, is as folks are falling off the cliff, you want to pick the guy, gal that is the last one to drop, potentially. And there's some other factors here, but that last one, everyone's going to go, they're going next. Their stock will go way down to near nothing, and that's the pennies on the dollar. However, you have no margin of safety, and that's one of the most dangerous games to ever play. I do not recommend it.
Right.
You got to go back a couple feet or more to have that edge safety, I like to call it.
Right.
And so, it's a fun game, but tough to predict.
you gave a good example we should slide in here, because you said there was a company that was really fundamentally a good company, Esurance, that got crushed, but there still was a business there. So just tell that story, because it is sort of value investing to sort of spot the company that has a real business, but somehow the market is crushing it, but you know it's going to recover, and you can invest with a large margin of safety, because this is really what you do, right? You look for those targets, right? So tell that story. Tell that Esurance story.
This is why I've been up a couple of days, not just telling friends that this is how it works, but looking for that opportunity, like Esurance was. After the tech bubble, this online insurance company started out with really good executives. Gary Tolman, who's still around, and he's running another InsurTech, and his team of folks went to near zero. But were picked up on the way down by an insurance company, of all things, and a stodgy one at that, and another devotee of Warren Buffett. And it was actually a firm started by Warren Buffett's insurance guy. So they picked him up for $19 million, and then they ran a little bit with losses here and there, not much more than that. There's this neat ratio over there called, I won't go in their ratio analysis, but they eventually sold to Allstate for $1 billion. And wow. Yeah, that's venture-like returns and you're buying something at such a deep discount. For White Mountains, that number 19 wasn't a really big number on their books. And they don't go for tons of those every year. In fact, it's pretty rare. They usually focus one maybe a cycle, 2, 3 at most. And they're very hands-off and good typically to management, which is, good if you can find that kind of rescuer. Value investors in this kind of role right now, we're the folks that put in the trough. And so while some people call us the vulture guys, we're not eating things. We're not destroying them further. What we carry out is to the other side, and a lot of us play the long term. There were some of us before this that were shorting the bank. And to a good extent, that's kind of sometimes a good thing that you need in finance. And that is having the lion to roam the markets to cull the herd of the sick. In this case, we found something that is really systematically bad. So you mentioned that there was Union Square had written something about this. Right. And there was a bunch of other folks that were actually, doing the same, blogging, saying that they had this stuff. And who knows who actually has skin in the game. But you can see them online. And even, our loudest voice in the Valley is a guy named Michael Burry that you may know from Big Short. Christian Bale, who played him. Michael is saying, we found our Enron. Well, and it was about that time with some other company blow-up. So I'm not sure if that's who he intended. I think he might be onto that. And then he said, hunting for our WorldCom, which you and I, we had as a final in the class. Right, I remember that. Financial analysis. Right. Prepaid accounts. Right. So let me ask you, are you seeing the potential for a domino effect among these smaller banks? Because there are a lot of other smaller banks that I imagine depositors are going to read the news or hear the news, and they're going to say, hey, I've got to move my money to maybe a larger bank. It's sort of a no-brainer. How quickly is just a few keystrokes and you can get it done. And if there's even a 1% chance of a failure, I think a lot of people are like, hey, I don't want to take that chance, right? Yeah. There's a natural sense to the world, and we can't avoid it. And what we've created is an unnatural sense by heavily regulating, trying to save. And in a sense, we brought all the animals into the zoo. And if a disease breaks out in this situation, they're all screwed. Right. Introducing interest rates rising is stressing all of the banks. And if any of the banks have anything special, like you just saw, a combination of, some concentration and potential clients that really need their cash, you got a problem. But we've seen other big banks have problems under stress, and they can be random. The Asian currency crisis, 1970s, or sorry, 1997-ish, among others. And that was obviously the larger global bank involved there. London Whale, JP Morgan. And that's obviously an issue with the trader and prop trading. And some of those have been clamped down. And they try and fix these things, but they try and regulate and they push over. And the unintended consequences is we have banks that don't make loans.
Right.
They could buy treasuries and markets, market securities.
Right.
One could say there is a scenario. Another rule of thumb. As a professional in this business, you don't want to cause any runs on anything. So what I'm about to say.
Stay tuned for part 2 of this episode of The Valley Current.